You have to be ready to sit still through maybe months of flat or even negative performance until you catch a big wave. A perfect example, cocoa prices. Since 2019, cocoa has practically fluctuated completely flat. And then cocoa prices suddenly go into this strong uptrend and they more than doubled, right? They went from 2,000 to 5,500. And all of my strategies caught that trend and they all reached new performance peaks. And over this whole period, they generated something like $1,500 per ton of cocoa. So that's a great gain. The problem is that you had to sit tight and wait for that to happen. Most investors find it very difficult to do that. And so one antidote to that is that A, you have to be sure that you can cushion the losses while they're, gathering. And B, you want to diversify.
Hey guys, welcome to Capital Cosm. Today I have a very special guest on the show. It is Mr. Alex Krainer. Alex, thank you so much for coming on, my friend.
Great pleasure, Danny. Good to join you.
As always, guys, nothing on this video is financial advice. Neither Alex nor I are financial advisors, so please do your own due diligence. And with that said, Alex, this is your first time coming on the show, so please give us a little bit of a background on who you are.
Yeah, so I am a Croatian national. I've been living for the last 27 years in Monaco. And I've worked as an oil trader. I've also worked as a hedge fund manager. And right now I run my own thing. I have a website, iSystem Trend Following. That's a service of my company, Krainer Analytics. And I provide market analytics and decision support for individual traders, investors, and to professional investment advisors as well. So in a nutshell, that's me. Any other details we can come around to subsequently.
Yeah. So you're primarily in the energy market, yes?
No, actually, I cover about 200 different financial and commodities markets. So I cover practically the full spectrum of commodities, less the London Metal Exchange. And I also cover futures of currencies, equity, indices, and treasury futures.
Yeah. So because it's your first time on the show, I just want to get a sense of your general market prognosis. What's going on in the markets at the moment on a broad level?
Well, we're in turmoil. We're completely in uncharted territories. The global events that are shaping the evolution of markets are unprecedented, and I think that it's very, very difficult to make useful predictions. We can make general global predictions about the long-term future of Western economies and the markets, but this is not necessarily helpful to traders because what's happening in the short term is what generally impacts your performance as a trader. Any reliable prediction will necessarily be looking at the long term. So, we can predict inflation, we can predict rising interest rates, we can predict that the stock markets probably are going to be in a bull market indefinitely, and I'll explain why I believe that. And we can predict recessions and depressions and things like this, but we can't predict what happens next week, next month. We can't predict reliably price targets. and things like that. So generally, for the last 25 years, the approach that I have adopted is what's called trend following, and in my case, specifically systematic trend following. So I've developed algorithms that simply tell me on a daily basis whether I should be long a certain market, or if I should be short, or if I should be out altogether. Now, circling back to the reason why I think that the stock markets are probably going to be in a bull market indefinitely is because one thing that took me practically all of my career to work out, because nobody really tells you this, is that far and away the most powerful force shaping stock prices is the central bank and its monetary inflation. So if central banks ease, stock markets go up. If central banks tighten, stock markets go down. This last period, let's call it 2022, has been an exception because on the surface of things, it looked as though the Fed was tightening. But as it turned out, there was some kind of a covert action to supply liquidity to equity markets all the same. And it went through Bank of Japan and offshore investment funds and whatnot. So the money went flowing into the stock markets as long as at the same time as the Fed was tightening and hiking interest rates.
Wasn't it done?
Otherwise,
Wasn't it done through the TGA as well? Didn't they drain out the TGA in the process?
Sorry,
didn't they drain out the Treasury General account as well in the United States?
yeah, it would. Yeah, it would appear so. But generally, for over 100 years, we had a very strong track record where you can see it's practically 100% correlation that when central banks inflate the monetary mass, stock markets go up. When they tighten, stock markets go down. We saw that, most recently we saw that in 2018 when the Fed kind of started tinkering with tightening, and then at the end of 2018 the stock market crashed about 20%, and then they reversed themselves practically on a dime, and then the stock market went back up. So I think that in 2022 they prepared a slightly cleverer approach, and I think that this approach can work temporarily because the thing that has changed with respect to the last 100 years is that today central banks around the world actually coordinate action. So the Fed can tighten at home, but at the same time provide a massive swap line to Bank of Japan or Swiss central bank, and then these banks can use that liquidity from the Fed to plow it back into the U.S. stock markets. Well, so we don't know really what we're dealing with, but we are going into a crisis of, into a recession. We're going into a very difficult period, and what's predictable is that the central banks will continue to ease and provide liquidity to the stock markets. So, for that reason, I believe that even if we go into a recession and even a depression, the stock markets could still go up a lot higher. It's the kind of scenario we've seen in, Argentina, Venezuela, and Zimbabwe. These economies were not doing well, but, in 2009, Zimbabwe's stock market was the best performing stock market in the world. In 2015-16, Venezuela's stock market was the best performing in the world. And, we've seen these episodes again and again and again in the around the world, and I think that now we might see it in the United States and also Western Europe and UK. All of the central bank are pumping money into the markets. Most of it is ending up in the stock markets, and so the stock markets are looking happy as everything on the outside world is rosy, which we know that it's not.
Yeah, so you mentioned several stock markets, including Venezuela, et cetera, that actually saw an increase in their stock markets despite their economic degradation. Uh, d- did those stock markets end up keeping track with the inflationary impacts of that monetary policy, or no?
No, no, they usually fall back. So when these events happen, and the first one of them was, well, first one that's really well recorded in history
Weimar.
and documented was the Weimar Republic in Germany. So a little over 100 years ago. So they had hyperinflation. Their stock market went vertical, but the inflation overtook the rate of inflation was about tenfold of what the rate of increase in equity prices was. So at the end of the ride, the investors who were invested in German equities got wiped out. So they made nominal gains, but in real terms they sustained severe losses, practically total.
Yeah, yeah. And if you live like somewhere here, like in the United States, you'd pay capital gains on top of your nominal gains, even with that.
Yeah, exactly. So it's not great. The only effective hedge against inflation that I know of, and I'm qualified to know this because I spent 15 years of my life running various inflation based hedge funds. The only effective hedge against inflation is exposure to commodity futures, because what happens in these crises of inflation is that actually is the purchasing power of your currency that is collapsing. It's not that the
Right.
prices of real assets are going up. So as the currency collapses, prices of energy, metals, agricultural commodities, they have a corresponding increase. And so by gaining exposure to these prices of commodities, you actually manage to offset the losses. And there's a lot of good research on this, and a company named Alliance Bernstein, which might be familiar to some of your viewers. They published a report where they measured actually how various asset classes respond to inflation over the decades. And what they found is they calculated a thing called inflation beta. Inflation beta says it measures how much a price of something moves along with inflation. So let's say if for every 1% move in inflation, some asset moves 2%, then that's inflation beta is 2. If it moves 1%, inflation beta is 1. So what they found out, the commodity futures had an inflation beta of 6.5, meaning that commodity prices move up higher at a rate of 6.5 fold over inflation. Stock markets, bonds, real estate, they all actually fall back. And then the only other asset class which has strongly positive inflation beta is farmland. But while commodity futures are 6.5, I think farmland is something on the order of 2 or 2.5, something like that. I don't remember off the top of my head. So at any rate, far and away the best is commodities futures. But that's unfortunately difficult for most ordinary traders and investors to trade.
Yeah, that's what I was going to say. What about equities, commodity equities?
I don't know, because the research that I'm aware of didn't strip out commodity
Gotcha.
equities as a category. So I think that they might turn out to be better than what do you call it, technology or biotech, or I don't know what else you might compare it with. But it's there's a commodity equities muffle. They're correlated with the prices of commodities. Like gold miners will be correlated with the prices of gold, but the price of gold might have a much stronger performance than the miners. themselves. So I guess it's a legitimate thing, but I couldn't tell you a definitive answer.
Yeah, and what's the name of this study you referenced?
It's called the publisher is Alliance Bernstein,
Mm-hmm.
and the report was published in 2010, and the title, off the top of my head, is maybe untangling inflation, or well, anyway, something to
Yeah.
do with inflation. I think it's a very good report, and I think if you put it into a search engine, it should come up. I think it's still available online.
Yeah, I'll look for it and we'll post it in the description box below, just so
Okay, yeah. I think that's a good idea.
yeah. So so commodity futures is according to this research, the best way to hedge yourself against inflation. Actually, come out ahead against inflation.
Yes.
And you also mentioned that you've created an algorithm that kind of allows you to trade long and short. What kind of trader or investor are you, Alex? Are you more of a short-term swing trader? Are you more of a long-term trader, investor? What do you?
Okay. So I don't know exactly how to categorize it. I'm definitely a trend follower, systematic trend follower. And now when you tell me short term, long term, so why the model that I've developed, I've deliberately developed it kind of agnostic to all of these, how do you call it, considerations. I've left it open uh, to be, how should I say, parameter driven,
Mhm.
right? So that it can accommodate short cycle trends, long cycle trends, and everything in between. And so, for let's say for every market I trade, I will develop at least 10, maybe 20 individual trading strategies, which then become, their own bot. So I don't know, if I were trading 20 lots of gold, I would use 20 individual trend following strategies, right? And then I would trade one lot with each. And so that I kind of have a gradual increase and decrease in exposure to the markets, rather than going long all at once and going short all at once. And so over the last 20 years that I've been using this same model, and over literally millions of simulations, I came to the conclusion that the most reliable strategies in terms of performance, long-term performance, are strategies that tend to look for long cycle trends, and B, that are always in the market. Now, the price of using those strategies is that you have to be very disciplined and very patient, because these strategies are slow to change direction, right? So they're not going to get you out at the top, and you're not going to buy at the bottom. It's going to let the price move in a certain direction before it actually tells you, okay,
It's
now
lagging.
go long. Or so that, for many traders, that's very frustrating, and the gains, they tend to accrue over years. So you have to be ready to sit still through maybe months of flat or even negative performance until you catch a big wave, right? Perfect example: cocoa prices. If you can pull up a chart of cocoa prices, you'll see that since 2019, cocoa has practically fluctuated completely flat, right? And so my strategies on cocoa were similarly just gradually going down, 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 long drawdown, and then over the last 12 to 14 months, cocoa prices suddenly go into this strong uptrend, and they more than doubled, right? They went from 2,000 to 5,500. And all of my strategies caught that trend, and they all reached new performance peaks. And over this whole period, they generated something like $1,500 per ton of cocoa. So that's a great gain. The problem is that you had to sit tight and wait for that to happen. Most investors find it very difficult to do that, and so one antidote to that is that you have to be sure that you can cushion the losses while they're, you know, gathering, and B, you want to diversify. So you want to, fragment your losses across many markets that are uncorrelated, so that you have a little bit of risk in cocoa and you have a little bit of risk in gold and silver and crude oil and copper and, wheat, soybeans, whatever. And then, when you're sustaining those losses over long periods of time, they're small, and, you don't lose any sleep over them. And maybe, in one period of time, palladium gives you big windfalls, and then in a different period, it's going to be gold, and the next one is going to be cocoa. And so this is in fact very typical for the performance of trend following funds, because there are some out there who are very good at what they do, and this is what everybody knows in this community. I know a good many of them, and they just make peace with the fact that markets are a sequence of feast and famine. You have to be able to endure the famine in order to capitalize on the feast. And so you just go through these cycles, and then over very long stretches of time, you end up coming out ahead. You end up if you're disciplined, if you're patient, you end up outperforming the S&P and the bonds and the 60/40 and all of these things. But it's a skill. It really does require proper risk management, iron discipline, and the patience of a saint.
Yeah, patience is key, especially nowadays. Everyone is very instant
Yes.
gratification
Yes,
minded.
exactly.
You look at the average trading time of a trader back in the 1960s, it's 14 years holding a stock. Today, it's less than 6 months.
Yes, and then performance goes accordingly, because I also for many years paid close attention to performance of different funds, and I looked at performance of traders. On some brokers publish some research on the performance of their clients, and even among the professionals, the empirical evidence shows that in any given year, about 2/3 of all active money managers underperform their benchmarks, and because the third that outperforms, there's a lot of turnover. It's not always the same third that keeps outperforming. It's over long periods of time. If you look at it over 5 or 10 year period, it's 95% of all active managers that underperform. And I think that one good way to underperform is if you trade too much, if you go by the news flow, that's trade the news and lose your shoes. That's that's how it is. And I think that among day traders, the odds of actually losing your money, not just underperforming, are something like 95%, and most of them don't even last a year.
Yeah. You also mentioned a sequence in terms of capital flowing into these various commodities. From what I understand, is typically in these inflationary cycles, you have capital initially flow into energy. Energy rises, it increases the input cost of mining metals. So then you have energy rising first, and then metals rising second due to increased energy input costs. Is that the way you also see it as well?
Well, yeah, we saw that, but the problem is that as soon as you work this out, in the next cycle, it might be completely different. Right. A good story about this is, if you remember Amaranth Advisors. So I forget the bloke's name, but he was was it 2009? He made like $1.6 billion for Amaranth trading natural gas, because he worked out some kind of a seasonal cycle that was tended to repeat itself in the natural gas market. And so he had a phenomenal year, made 1.6 billion for Amaranth. But then the year following, this cycle broke, and he ended up single-handedly sinking the company. He lost 6.5 billion, and that was the end of it. I think his name was, it escapes me. It doesn't matter. Amaranth Advisors. It's easy to look up, and it's quite a remarkable story. But this keeps happening again and again and again, that people work out some kind of a correlation in the markets or some kind of a cyclical relationship, and then they say like, okay, well, we'll run with that. LTCM was also a perfect advice, long-term capital management, a perfect example of this. They worked out long-term correlations between two sets of data. Mm-hmm. They ran with that. It worked really well for a few years, and then in 1998 it collapsed, the whole thing, because the relationship suddenly changed, and you cannot predict those changes in relationships.
Why did the relationship change? Did they find out?
Well, the reason why the relationship changed was first we had a 1997 East Asia crisis, financial mm-hmm. crisis of all these Asian tiger economies. And then by 1998, it kind of contaminated Russia. The contagion spread to Russia. And LTCM was very active trading certain Russian securities. And this is where they got wiped out, because in 1998, Russia defaulted. And so LTCM got razed to the ground. So it was the default. But, such things cannot be predicted. If they were predictable, people would have bailed before it happened. But you don't know. And then especially today, when we are completely in uncharted waters in so many ways, the asset valuations, the monetary mass, the inflation rates, the interest rate, it's like everything is off kilter. And so we have to expect disruptions and changes in historical patterns, because our views about the markets, everybody who's trading today has kind of learned their skills over the last 10 or 20 or 30 years. And one process that we had over these 30 years, a continuous trend of decline in interest rates, right? And the rise in the price of treasuries. U.S. interest rates in particular are the world's most important price and the world's largest market, because they affect everything else. And so now we're at the precipice of this changing. We see interest rates starting to go up, and maybe this trend will last for many years. And so everything that we think we know about the markets, because we've seen these past 30 years of certain environment, might be turned on its head over the next 10 or 20 years. So, putting too much faith in relations and correlations and cycles that we can measure from past data, it's rife with risk, and people have to be very careful about that.
Yeah, because history is finite, the future is infinite, and just simply
exactly. Exactly.
Yeah, so there's infinite possibilities ahead of us. We only have a finite set of prior events. Hey guys, quick pause. I won't take too much of your time, but I just wanted to let you know that if you want to use and read the same newsletter that I do, Capitalist Exploits, we have a special $1,000 discount exclusively for Capital Cosm viewers of this channel. You simply have to click on the link down below, get your $1,000 discount. Super stoked about this. I discovered Chris and Brad's newsletter, Capitalist Exploits, 4 years ago. It set me on my investment journey. I attribute a ton of what I know to that newsletter. So if you haven't already, check them out. Click the link down below to learn more. Take advantage of this $1,000 discount. You're not going to find it anywhere else. All right, now let's get back to the video. And then at the same time, looking at things from a purely technical analysis, quantitative view, naive to any additional color with respect to like geopolitics, etc. Again, that's very naive to the model. So if you're just looking at price action history over time, for example, in 2022, oil spiked to $140. The only way you would have got that is you would have predicted the Ukraine-Russia conflict, right?
Well, yes, for example, but you see, today the oil price barely moved, and we had, in addition to Russia-Ukraine conflict, which hasn't improved, it's only gotten worse, and the sanctions have only been getting bigger, and all of these things. You got massive turmoil in the Middle East, which is risk, which really makes it possible that we're going to have extraordinarily major interruptions there, because if it comes to the closure of the Straits of Hormuz, that's like 20-25% of global oil trade that no longer flows. So you would think that oil prices would already start spiking, but they're barely moving. So it's very I find that it's very difficult to make those predictions, and sometimes things go opposite of what one would expect. I know that throughout my careers, I got killed on certain trades that I thought were great. Like, I don't know, if today I got a signal to go long oil, I would think that's great because everything else tells me that that makes sense. Oil should go up. And then maybe you get killed on that trade because for whatever reason, oil price collapses. You know, it happens. And sometimes I made uh, tremendous profits on trades where I actually cringed to put in the order because I thought this is so stupid. It doesn't make any sense whatsoever. And then, boom! Sure enough, the market goes in the direction you would think is wrong, and you end up making money. So I've really learned to be completely agnostic with regards to any predictions, because it's really a 50-50 business. Sometimes you'll get it right, other times you're going to get it wrong. And if there was something to predicting things, one thing you would find in the markets was that traders with more knowledge and more experience should outperform the ones with less knowledge and less experience. But that doesn't hold either. Sometimes very, very learned, very experienced, very successful traders end up getting killed. We see that all the time. And sometimes young rookies may end up making a killing. They think they're geniuses, but maybe they were lucky. And so all of these things kind of turned me into a trend follower, because trend following allows me to not think about all these things. The algorithm tells me what to do, and I do that. And I already know in advance that every other trade is going to be a loser. I know that, so I don't put much stock into, if I buy oil today, I might make money, I might lose money, but I'm not so concerned about that. I'm concerned about the long sequence across time of all of these trades: gold and oil and copper and wheat and soybeans and everything. And I'm concerned that when I trade them, I lose less money when I'm on the wrong side than I make when I'm on the right side, so that there's a asymmetry between my profits and losses. And then over a long period of time, they kind of tends to be adding up, and then you get long-term positive performance, even if you don't know anything about any market, even if you don't make any prediction about anything.
Yeah, it's not about, you're not trying to be 100% accurate. You're trying to be, I'm going to make a number up, 52% accurate, 53% accurate, or you're playing with expected values, right? You're yeah, on average over time, you're going to get it right more than you're going to get it wrong, and that's where you get your edge over everyone else.
No, just a small correction. Actually, you tend to get it wrong more often than you get it right. In my case, it tends to be 60-40, actually. 60% of all trades are losers, 40% of all trades are winners, but the 40% significantly outweigh the 60% that are losers. So it's the difference between gains and losses that actually kind of slowly pushes you on the positive side. It's like a breeze that carries you if you have your sails up.
Yeah, quality over quantity. You're not. It's not essentially. You're looking for quality. You're hoping that quality trades make up for the quantity of losers.
Yeah, exactly,
Yep.
exactly.
So you mentioned trend following. What kind of trends do you look at, for example?
Generally in futures markets, as I said, with exception on London Metals Exchange, and generally medium cycle to long cycle trends. So trades that might be open for a few days if they're if we take a loss. But if they're successful trades, I might be rolling them over for months. I might have trades that don't change for 12 months, 18 months, etc. So it's always based on daily market data. So I don't look at intraday data at all. I ignore them. Generally, when you put on trades, you put them on at a regular time of the day, not at any target price, right? And the reason for that is that I don't want to get involved in trying to guess good intraday price targets for execution. So I say, okay, I'll execute all my trades about 1 hour after the market open. So that's what I've been doing for 15 years. And I know from talking to many other trend followers that they do similar things, because short-term price fluctuations are random. You're gonna improve execution one time, other time you're gonna not improve it. At the end, it's really a wasted effort. So you just like put it there 1 hour after market open, or 1 hour before market close, or in the middle of the day, whatever. You make a decision, and that's what you do every day. So that's the way I've been doing it, and it. Let's say it gives you the peace of mind of not having to stare at the ticker screen all day.
Yeah, yeah. I'm all about identifying edges, and one edge that people often don't look at is your psychological edge. If you're constantly worried, stressed out over your positions, then eventually it's not going to play to your benefit. It's going to play to your
Yeah,
downfall.
yeah, exactly. Correct.
Great. So, what are some of the top risks you see right now, culminating in the markets?
Oh, I think. Oh gosh, there are so
Yeah.
many.
So I said top.
You have the. Yeah, well, I should say geopolitical
Mm-hmm.
risks, because there we are really coming to the end of a system that's been intact and that's dominated global markets for several centuries now, maybe 500 years, which is the primacy of the West, where Western powers were dictating the terms of the game. They dominated global trade. They dominated global capital flows, the finance, the system of payments, the system of credit creation. And we are now really truly coming to the end of that. If you look at the last 30 years, you see that the global share of the GDP of Western nations, so let's say North America, it was, gosh, I think North America and Europe combined, maybe they they were about half of the global GDP. I'm talking purchasing power base, right? Because the GDP, the nominal GDP, is a bit meaningless. You have to always set it at purchasing power parity. And today, USA and Europe are at about 20% of the global GDP, and the each, right? And the East Asian economy, Asia Pacific, is at about 60% of the global GDP, or maybe 50. I forget. I had this chart in front of me yesterday. Now the trends are very clear and very obvious, and they span 3 decades. Where United States, North America, Europe have a declining trend, so they're losing the share of the global GDP, and Asia Pacific has a rising trend over this 30-year period. So I think that this trend is going to continue. We in the West, we're getting lost in these perpetual wars. They cost absolutely astronomical figures. They are diverting the society's productivity towards a destruction economy rather than creation economy. So you see that the infrastructure is crumbling. Services are, being diminished and reduced, and they're growing more expensive. People are rapidly losing purchasing power. The standards of living are decaying. And so, these are very, very robust trends that are going to continue. And so, with what the Western powers are now doing desperately to try to arrest and reverse these trends is they're trying to win back the world's productive areas, resource exports, and large export markets. They're trying to win control over them by force, waging war in Ukraine, waging war in the Middle East, or trying to orchestrate a war in Asia Pacific to try to kind of destabilize China and get China back under Western control. But these are extremely risky gambits because it's obvious that the Chinese and the Russians are reading Western leaders like an open book. We are beset by extraordinarily incapable and incompetent leaders, and so it's just the lunatics took over the asylum, and the price will ultimately be paid in terms of lost standards of living, lost purchasing power, diminished economies, diminished productivity, diminished innovations, and so forth. And ultimately, that's going to have an impact on capital markets. As I said, the stock markets might go up, but they might be these gains might be outstripped by inflation, and then you're still losing. So you have to look at gold, you have to look at silver, you have to look at farmland. I don't know. I'm a bit agnostic on Bitcoin and these things because I think they're legitimate diversifiers, but I don't know. I was very enthusiastic about Bitcoin when it was in the hundreds. 500, 400, $600. But there's a price on everything. Would you buy a barrel of oil for $1,000? You hesitate, but buying it at $80 might be reasonable. Same with Bitcoin. You might think one thing about it at $500 or $1,000 a Bitcoin, but at $40,000, it's not the same thing. You can't just keep buying things no matter what the price, because then we're going into the tulip mania territory where most people are going to end up wiped out, even with these good, legitimate diversifiers, because if you buy it at a price that's too high, you're asking for trouble.
Yeah. So we're basically seeing the tail end of this 500-year reign of the Western powers, let's say. You mentioned 60%
Yes.
of global GDP is now coming from Central Asia. If you don't mind sending me that chart, I'll post it in the description box below.
Oh yeah, I can do. Yeah, I can do that. I can do that. I think that would be useful because I might have made a mistake with the numbers. I'm not sure anymore, but it's something very substantial. And so when I send you the chart, then we'll clear it up.
Yeah, that'd be fantastic. Well, we're closing in on time here for our interview. I want to give you enough time to give any closing thoughts before we sign off.
Any closing thoughts? Well, I do actually, because a lot of things are coming apart, even not geopolitical, but within our societies. And over the last 2 years, I've been quite active, speaking, going to conferences, and writing about how do we survive the coming crisis. And I came to the conclusion that the most powerful way for us to gain resilience is simply by creating and cultivating local communities. Okay, so this has nothing to do with trading and investing, but we've been lulled to sleep where everybody lives in their own bubble, between their driveway and their office, with their takeaway coffee. Nobody talks to their neighbors, and tomorrow you might find yourself where like your roof is leaking and you can't get any repairman, but maybe your neighbor knows how to do that, and maybe you have a neighbor who knows how to fix teeth, and another one who knows how to set up local area networks and fix the internet. So it's extremely important for people to reach out to their neighbors, get to know them, organize get-togethers, barbecues, talk, discuss, learn who knows how to do what. The confirmation that we were on the right track with this, because I participated in several of these conferences, is that, for example, I went to a conference last year in Ireland called Think Local. And this was exactly it, people getting together, bringing their, let's say, local products and services so that people can see them and know about them and buy them, discussing among themselves about their challenges, about potential solutions and so forth. And also bringing some speakers to talk about, money, about banking, about the energy market, whatever, so that people are well informed and understand what's coming at them. And the beautiful confirmation that this was exactly what's needed is that the Irish government went out of their way to try to prevent the conference, right? So there was no, you have to understand, there was nothing even remotely that could be interpreted as extremism here, as hate speech, as any kind of a negative that you might say, like, oh, this is trouble. This was literally ordinary law-abiding Irish people trying to get together and know each other and talk about their challenges and discuss solutions. And in the end, the way we were able to have the conference is that the organizers, after having two venues cancel them under pressure from government, they had to organize it at a fake venue, right? So they organized it at a venue and then pretended that it was in a different venue. And then when people came to the conference, there was somebody there telling them, no, it's not here, it's over there, but we couldn't tell you because they would come and shut us down. So, the governments want to keep us helpless, dependent, compliant, obedient. And that's why they don't want us to talk to one another. They don't want us to organize to solve our own issues and gain a certain resilience and self-reliance. And so they're very desperate to prevent social gatherings of local communities. And then this tells you that this is exactly what we need to do. And then, look at farmland. If you can buy any small plot, it's better than nothing, better than holding cash. And then if you can, get some exposure to commodity futures. And in this sense, I can also be of some help because I do publish daily Trend Compass Markets report that deliver directional exposure and timing signals, namely when to buy and sell what. And I cover about 200 markets. And generally for retail investors, I have subscription rates that are a bit lower than what's advertised on my website. So 1 month free trial is always on the house, so people can get a test drive. And if that could prove helpful, then that's available. So that's how I can help.
Yeah, what's the name of the website?
It's called iSystem Trend Following. iSystem-tf.com.
Okay, we'll have that in the description too.
Yeah, I appreciate that. Thank you.
Yeah, well, it was a great pleasure having you on, Alex. I really enjoyed this conversation. Hopefully we can have more in the future. And if you guys enjoyed this conversation, be sure to give it a like, subscribe to the channel if you haven't already, and comment down below. Let me know what you think of Alex's points. Do you agree or disagree? Let me know in the comments below, and I will see you in the next episode. Bye, y'all.
Thank you.